Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your daily technical analysis of foreign exchange markets.
Euro-dollar. A new recent high open and high close yesterday, though not a new high, one not seen since April 2022 actually. However, despite the main body being higher, it was still yet another indecisive spinning top. Now, as you know from me pointing it out over the last few weeks, we have seen a market capped by the rising middle time, currently at 109.63, which is highlighted in bright red on my daily chart. And that's of the late November 2022 to early January this year bullish Andrews pitchfork. Now, I was inspired today to draw a bullish shift pitchfork with the same move, now primarily to see when any crossovers would happen. And lo and behold, we have a crossover at the start of this week. You can see the crossovers highlighted in light red circles on my daily chart. These time crossovers are usually accompanied by one or more of the following: a change in trend, a reinforcement of an existing trend, and volatility. I have now concern that this past Monday's time crossover may be a peak for this market, especially as the interesting but untested 50% Fibonacci line of the January 2021 to September 2022 move is nearby at 109.44. Looking again at the bullish Andrews pitchfork, this has been showing the bullish angle of attack still here since the start of the year, so I would still subscribe to that, at least for now. Meanwhile, support below is again, unsurprisingly, the May 2020 low at 107.66 and the April 2020 low at 107.25. Now, so far today, initially a little lower, but with a spike higher over yesterday's high, but not as far as Monday's high, before prices came down to a little lower than the open. And the market looks potentially like a possible shooting star pattern right now. Cable, aka sterling against the US dollar. A second bearish black crow yesterday as the market dropped down and tackled a combination of the extension of the breached lower trend line, currently 123.44, of the September 22 to January this year ascending wedge pattern, plus the 50% Fibonacci line on the June 21 to September 22 move at 123.16. I've highlighted the ascending wedge pattern in dark blue on my daily chart. The market pierced both these supports but was unable to reach the next support at the June 2020 low at 122.48 and ended up closing below the trend line but above the 50% Fibonacci line. Overhead, we have resistance at the December 22 high at 124.45 and this week's high at 122.47 that pushed the envelope a little higher by a couple of ticks. However, I was inspired today to draw a bullish shift pitchfork for the same period as the bullish Andrews pitchfork, primarily to see where the crossovers were. They are in mid to late February, but what I found interesting was how the middle time, currently at 124.72 of this new bullish shift pitchfork, capped the market last week and this week. I've not highlighted this shift pitchfork, you can see it, but it's not highlighted, as it would make me dizzy looking at it with all the others. But the middle time is there as resistance, and so far it's done a good job. Anyway, apart from these pitchforks, the late September to late November 22 ascending wedge pattern is still one of the most relevant patterns here. Prices had previously managed to reach the primary target for this pattern in the 124.20 area, though we still have opened the secondary harder to reach target X3 up in the 128 even area. Well, so far today, well, initially seemingly caught between the 50% Fibonacci line and the trend line extension. The real core of support here is still the untested lower time, currently at 121.95. And though we are currently lower, the market does not seem comfortable to try down that far. Not just yet. Euro sterling. A third bullish white soldier yesterday, and a continuation onwards from the recent bullish engulfing pattern. These recent sessions have been a somewhat counter-reactionary move higher after the earlier attempts lower had failed, especially in trying to penetrate the combined supports of the April 21 high at 87.19 and perhaps more importantly the swirling entwined mass of the medium moving average currently at 87.32 and the short medium moving average currently also at 87.32. These two moving averages had made what I call the mutated golden cross towards the start of January, with the moving averages entering in the wrong way round, followed by a genuine golden cross 2 weeks ago. Meanwhile, overhead, well, we don't have that much until the 50% Fibonacci line of the March 20 to March 22 move at 88.51. And the market approached this resistance yesterday but shied away from actually testing it. You may remember this resistance as it was the cap on the roof pattern seen back in November last year. But interesting to see if interesting to see if the same happens again now. So far today, well, a move higher, testing the overhead 50% Fibonacci line at 88.51, but not really pushing through it. Beyond this, we have the January high at 88.97. But the next real piece of resistance will be the two adjacent congestions of 89.18 and 89.25. However, this is looking like the beginnings of a possible small shooting star pattern right now. US dollar against the Indian rupee. A second bullish white soldier yesterday and a suitable follow-on higher to the previous session's combined key reversal up and bullish engulfing pattern. These moves higher had been a reactionary response, and I suspect the reason we saw that happen in the first place was due to last Friday's first dip and close below the recent 50% Fibonacci line at 81.13. On Friday, the move low was not strong enough to tackle the next support, which was the early August to date uptrend, currently at 80.98, with the market stopping short and closing just over it. I've highlighted the support in bright red to not only show it more clearly, but also acknowledge its role as the lower trend line in the August to September 2022 ascending triangle pattern. That was so influential during autumn and winter last year. Now, one other factor I'd like to introduce here. I'd previously drawn an October 22 to January 23 bearish Andrews pitchfork, which I had conveniently highlighted in dark blue. The market is at the moment in between the upper tie and overhead, currently at 82.30, and the middle tie below, currently 80.20. Well, I was inspired today to draw a bearish shift pitchfork for the same move, and I noticed two features. Firstly, the middle tine of the bearish shift pitchfork, currently 81.59, is in amongst the market action right now and is seemingly acting as on a closing basis, bearish resistance. Secondly, the lower tine had a crossover with the middle tine of the bearish Andrews pitchfork, currently at 80.20, yesterday. As anyone who knows my commentaries will testify, I always say that when you have such a crossover, look out for one or more of the following: a change in trend, a reinforcement of an existing trend, and or volatility. Well, this week may well have started one or more of these three. However, before you get too carried away, yesterday's high was capped by the slowly rising medium moving average, currently 81.79, with the short medium moving average currently 81.98, also not too far away. Finally, as I've said in recent days, the big pattern here, and I suspect the reason why the supports below had become very influential, is not the bearish Andrews pitchfork, though it is a big enough pattern on its own. Rather, it is the action since September 22 to date, forming a large double top Adam and Eve type. We are currently on the final leg move lower, and this pattern will very much depend on whether the market will drop down to the neckline of the pattern, which I'm currently indicating as being in the 80.20 zone. Once there, if we get there, then it will depend on what the market will do. So far today, well, another attempt higher at the medium moving average, but getting capped there once again, and prices pull back to the middle tine of the bearish shift pitchfork and looking like an indecisive doji cross right now. US dollar against the Brazilian real. Yesterday saw a combined key reversal down and bearish engulfing pattern, if only just on the latter. To be honest, the bearish engulfing pattern wasn't the hardest of things to accomplish, as the previous session was an indecisive doji cross, though with a long tail. Prices punched down through the support at 520.31, as well as a slowly rising long moving average, currently 518.69. However, though the subsequent fall was significant, it was through a sparsely supported zone with nothing below until the 38.2% Fibonacci line of the June 2019 to May 2020 move at 510.87. And the market did not even manage to get down that far, though it did close reasonably near to the low for the day. Below the 38.2% Fibonacci line, we have further Fibonacci-based support at 507.39 and 505.73, followed by the middle time, currently at 504.86, of the well-bashed and broken July to September 2022 shallowly bearish shift pitchfork. This pitchfork is highlighted in dark blue on my daily chart and had seemingly repaired itself despite the earlier onslaughts. Meanwhile, overhead, we still have the 50% Fibonacci line of the March 21 to May 22 move at 522.76, plus the flatlining medium moving average, currently 525.01, and the jinxing short medium moving average, currently 526.37. And that is before we can even reach the combination of the 50% Fibonacci line of the May 20 to April 22 move at 527.37 and a declining upper time, currently at 527.87. Over all this, perhaps the most interesting recent action had been already partially happened by the 12th of January, and that was the setup for a monthly key reversal for January already. If we close on the 31st of January, either under 518.51 or over 528.60, then we'd be on. Anything in between and we'll have the lesser outside month pattern. Right now we've moved from an outside month and into monthly key reversal down territory. US dollar against the Mexican peso. A third bearish black crow yesterday, but it was pretty close to either an inverted hammer pattern, which is an interesting pattern as it's seen traditionally as a bullish reversal pattern, but the data indicates it is a bearish continuation pattern almost 7 out of 10 times. Or yesterday was a lopsided indecisive spinning top, with the spinning top part close to the low. Either way, the small main body of today's action, of the day's action, straddled the well-broken upper time, currently at 1878.10, of the big old March to July 2022 bearish Andrews pitchfork. I would so like to retire this pitchfork, but as long as the market does things like this, providing dynamic support or resistance, I will keep it despite it cluttering up my daily chart. Overhead, we still have the middle time, currently at 19.0050, of the late September to mid-December 2022 bearish shift pitchfork, which I've conveniently highlighted in bright red on my daily chart. Whilst below we have the old neckline of the January to May 2021 head and shoulders top, currently at 1868.55, as well as the lower time, currently 1863.47, of the large March to July 2022 bearish shift pitchfork, which is highlighted in dark blue on my daily chart. Thus, it'll be interesting to see which way the market follows on the inverted hammer pattern, tradition or the data. Now, so far today, a further dip lower, but only by a little. And prices have recovered back up, but again, only by a little. Though we are still awfully close to that broken upper time of the old Andrews pitchfork.
Thank you for listening. This short version broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.